Archegos Capital, the $20 billion collapse that shocked Wall Street. What if a single hedge fund, operating in near secrecy, could shake the foundations of Wall Street and trigger a cascade of losses totaling $20 billion in just days? In March 2021, that's precisely what happened. Archegos Capital Management, a family office run by Bill Hwang, used complex financial instruments called total return swaps to quietly amass massive positions in a handful of media and technology stocks. When the music stopped, several of the world's largest banks found themselves scrambling to cut losses that reverberated through global markets. This was not just another market hiccup. It was a sharp reminder of how hidden financial leverage can amplify risks, even among institutions thought to be the most sophisticated and well-prepared. To understand why the collapse of Archegos Capital Management was so shocking, we first need to unpack what this entity truly was and why it mattered. Founded by Bill Hwang, a trader with a history at Tiger Management, Archegos was not your typical hedge fund. Legally classified as a family office, it managed private wealth on behalf of Hwang and his family rather than external investors. This classification exempted Archegos from the stricter regulatory disclosures required of public funds, allowing it to operate more opaquely. Over time, Archegos developed concentrated bets on a small basket of stocks, particularly in the media and technology sectors, including Viacom, CBS, Discovery, and Baidu. By employing total return swaps and other derivatives, Archegos did not directly own these stocks. Instead, it gained economic exposure to them, with the benefit of substantial leverage. Why does this matter? Because leverage magnifies both gains and losses. Bill Hwang essentially used borrowed money, funneled through prime brokers like Credit Suisse, Nomura, Morgan Stanley, and Goldman Sachs, to increase the size of his bets to several times the capital he actually owned. This became a significant vulnerability. When the prices of key stocks flagged, these banks issued margin calls, a demand for Archegos to post more collateral to cover potential losses. When Archegos failed to meet those demands adequately, the prime brokers began liquidating the underlying positions to protect themselves, pushing down stock prices further and triggering a rapid and chaotic unwind worth approximately $20 billion. So how exactly did Archegos pull off this maneuver? A total return swap is a derivative contract that allows one party to receive the total economic returns of an asset, including dividends and capital gains, without owning it outright. Think of it like betting on a horse race. You don't own the horse, but you get paid as if you do if the horse wins. Archegos used these swaps as a stealthy way to build enormous positions without the usual public disclosure requirements tied to direct stock ownership. This tactic allowed it to fly under the radar and avoid triggering regulatory filings and market scrutiny about large ownership stakes, even as its exposure ballooned. Here's how it worked, step by step. Archegos would enter into total return swap agreements with prime brokers. These brokers would borrow the stocks, usually from their clients' holdings or other custodians, and lend them to Archegos. In return, Archegos would commit to paying periodic fees, interest, and any depreciation in the value of these positions. Meanwhile, if the stocks appreciated, Archegos would receive the gains. The prime brokers, meanwhile, carried the actual shares on their books temporarily and held the legal ownership, but the economic risk was passed to Archegos. Because these swaps were off-exchange derivatives, they lacked the transparency of traditional stock purchases. Archegos thus effectively controlled these large stock exposures without appearing on shareholder registers or in public filings. Leverage came into play because Archegos financed these positions with borrowed money, enhancing their economic exposure well beyond their equity. Some estimates suggest the leverage ratio was as high as 10 to 1. For instance, with $100 million in capital, Archegos could manage positions worth up to $1 billion. This created a ticking time bomb. If prices rose, returns skyrocketed. If prices fell, losses mounted quickly. Compounding these risks was the fact that these large bets were concentrated in a handful of stocks, the very stocks the market turned wary of in early 2021. When the stock prices began to decline, prime brokers started issuing margin calls, requiring Archegos to post additional collateral. Reports indicate that at one point, the total exposure of Archegos hit nearly $50 billion, with around $10 billion tied up in Viacom CBS stock alone. Hwang was unable or unwilling to meet the growing margin demands. This forced the prime brokers to unwind positions by selling shares rapidly to recoup their lent funds. The sales by the brokers amplified selling pressure, pushing stock prices lower and causing a feedback loop of losses. On March 26, 2021, the sell-off hit a crescendo and banks began taking losses. The impact was staggering. Credit Suisse alone announced losses exceeding $5 billion linked to Archegos, the largest quarterly loss in its history. Nomura Holdings revealed losses of almost $2 billion, while UBS and other banks also reported significant hits. Morgan Stanley, while involved, fared comparatively better by swiftly reducing exposure. The entire event exposed glaring flaws in risk management practices at these banks. Many prime brokers underestimated both the size and concentration of Archegos's positions because the swaps obscured real exposure. This lack of transparency hampered effective risk assessment and left banks vulnerable to a margin call that snowballed into a full-blown crisis. To put this in perspective, the Archegos debacle bore some resemblance to the 2008 financial crisis, but on a smaller scale and a narrower scope. Similar to how Lehman Brothers collapsed under the weight of opaque mortgage-backed securities, Archegos's failure highlighted how off-balance sheet exposures, complex derivatives, and excessive leverage can catch even the most sophisticated institutions off guard. Compared to the 2008 crisis's losses in the hundreds of billions globally, the $20 billion loss seems more contained, but it still sent shockwaves, especially across lending and prime brokerage divisions. Moreover, the episode underscored the risks posed by family offices or investment entities that escape the usual regulatory oversight, a point regulators took note of. The broader implications extended beyond the immediate financial losses. For one, Archegos's collapse led to a renewed call for greater transparency in derivative markets. Regulators and market participants began pushing for reforms requiring better disclosure of notional exposures and risk positions linked to total return swaps and similar instruments. On the banking side, many firms reassessed their internal risk controls, focusing on counterparty risk and concentration limits. The episode also fed into debates about the systemic risk posed by non-traditional investors like family offices, which had grown dramatically in assets under management in recent years, now totaling several $1 trillion globally. Global markets themselves were momentarily rattled. Stocks of companies involved in Archegos's portfolio experienced sharp price declines in March, with Viacom CBS shares dropping by nearly 30% within a week. The sudden sell-off, driven by forced liquidation, caused volatility spikes, particularly in media and internet stocks. Beyond direct market moves, Archegos's failure strained prime brokers' balance sheets and credibility, impacting their willingness to extend leverage and possibly tightening credit conditions for hedge funds and family offices. This ripple effect underscored how interconnected modern finance has become, where a relatively small player can influence global capital flows through leverage and derivatives. For individual investors and the average person, the Archegos saga is a cautionary tale about the hidden complexities in financial markets and the risks of leverage that extend well beyond retail traders. While most people cannot engage in total return swaps or take such outsized bets, the event highlights how even the biggest banks can misjudge risks and suffer big losses. It also emphasizes the importance of transparency and sound regulation to prevent similar events from escalating into broader crises that could affect pensions, savings, and the broader economy. For those investing in the stock market, the lesson includes appreciating the forces behind price movements. Sometimes they are driven not by company fundamentals, but by opaque trading strategies executed by entities with outsized influence. Looking ahead, the question remains, how can the financial industry and regulators adapt to better monitor and mitigate the shadow risks lurking within derivatives and leveraged positions? In a world awash with complex financial engineering, are we equipped to prevent another Archegos-like episode, or will the next shock be even larger and more destabilizing? As markets evolve, so too must the tools and oversight designed to preserve stability. The Archegos collapse is a dramatic chapter in the ongoing story of finance, one that reminds us that beneath calm market surfaces can lie hidden storms waiting to strike. The takeaway here is that the Archegos Capital Management collapse illustrates the critical importance of transparency in financial markets. Investors should be aware that market movements can sometimes stem from hidden strategies rather than the underlying value of companies. This event serves as a reminder for regulators and financial institutions to enhance their oversight and risk management practices to prevent similar incidents in the future. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Long-term capital management, the hedge fund that nearly crashed the economy. You will not want to miss it. I will see you there.